how SIFs are different from PMS, AIF, and mutual funds.
SIF is a very new category now for investors, and in February of 2025 was the time when SEBI came up with the circular on SIFs. The good part about SIFs is that they can do everything and anything that a mutual fund can do.
How does these long-short strategies actually generate returns?
So any kind of an investment strategy, so whether it is fixed income, whether it is a long-short fund, whether it is a large cap mutual fund or a small cap mutual fund, everywhere you have benchmarks set.
Most frequently asked question by the investors and the distributors, like what potential that SIFs hold to generate alpha over the traditional mutual funds?
So generally what we've observed, and this is mathematical data that we've analyzed, is that returns come in bursts.
मार्केट्स गिर रहे हैं, वॉलेटिलिटी हाई है और इन्वेस्टर्स सिर्फ एक ही सवाल पूछ रहे हैं कि अल्फा कहां से मिलेगा। हेलो एवरीवन, दिस इज संदीप सेठ फ्रॉम SIF 360। आज हम बात करने वाले हैं एक ऐसे स्पेस के बारे में जो ट्रेडिशनल म्यूचुअल फंड से बियॉन्ड जाके अपॉर्चुनिटीज क्रिएट करता है, स्पेशलाइज्ड इन्वेस्टमेंट फंड्स, SIFs. And to break this down, today we have Mr. Chinmay Sathe with us, who is the Chief Investment Officer for SIF from the Wealth Company. He brings over 20 years of experience in the Indian equity market, having worked with leading institutions like UTI Mutual Fund, DSP Merrill Lynch, Bajaj Allianz Life and L&T Mutual Fund. उनका कोर फोकस रहा है रिस्क एडजस्टेड रिटर्न जनरेट करना थ्रू डायनामिक एलोकेशन, लॉन्ग शॉर्ट स्ट्रेटजीज एंड डेरिवेटिव्स लेड रिस्क मैनेज, स्पेशली ड्यूरिंग वॉलेटाइल मार्केट फेजेस लाइक टुडे. So if you want to understand how smart money actually navigate markets, this conversation is for you. Thank you so much. So let's welcome Chinmay Sathe.
Thank you so much.
So Chinmay, thank you for coming on the show today. And let's start with the most common question that we come across, that how SIFs are different from PMS, AIF, and mutual funds.
Right. So SIF is a very new category now for investors, and in February of 2025 was the time when SEBI came up with the circular on SIFs. The good part about SIFs is that they can do everything and anything that a mutual fund can do, and plus something. And the plus something is the exciting part in an SIF. So generally what we've seen is that most of the people are invested in mutual funds. Some have invested in PMS and AIF as well. How does an SIF rank is that the minimum ticket size is 10 lakhs in the case of a SIF, which
Right.
is much more lower than a PMS and an AIF, which is
Yeah.
at 50 lakhs and a crore. So
Mhm.
the first point of differentiation is the ticket size.
Yeah.
Though it's higher than the mutual fund, but it's still manageable as compared to the higher ticket sizes of PMSs and AIFs.
Yeah.
That is first point. Second thing is, in the case of SIFs, you are allowed to take certain derivative related positioning, and derivative is the key differentiation factor in an SIF compared to a mutual fund and compared to a PMS. In AIFs, you have a scope for using derivatives, but then when it comes to taxation,
Yeah.
the taxation advantage in the case of SIF is much superior.
Mhm.
So you have LTCG, STCG applicable even though you're using derivative products. Whereas in the case of AIFs, you're taxed at fund level and that too at full tax level whenever you're using any kind of derivative instruments.
Mhm.
So on taxation function or on taxation front itself,
Mhm.
SIFs will appear to be superior on a post-tax return basis.
Right.
Okay, and so that's one of the key differentiations. And when we think about derivatives, it's a way of expressing yourself. So how are you expressing yourself negatively? And SIF is that avenue which allows a fund manager to express himself and herself negatively as well, in a way that something that is not looking good, can you make money by selling that stock,
Mhm.
by shorting the stock? That's something that can be expressed.
Mhm.
And in this process of
Yeah.
introduction of derivatives, the main part that comes is the risk management capabilities. So
Right.
as the most exciting part to me in an SIF is how you can manage risk better.
Mhm.
So derivatives for me is a function of getting better risk control over my portfolio, managing drawdowns, managing the quantification of risk, what kind of risk that I'm taking, assessing that risk, managing that risk, and getting a higher return per unit risk that I'm taking. And and all of these are possible using derivatives.
Right.
So I'm very excited about this product particularly, and as the CIO, the entire product is designed by me, and looking forward very much to the launch of our two SIFs.
Exciting, to me it looks like it's best of the both worlds, like simplicity of mutual funds and taxation like mutual fund and the flexibility of AIFs, which was not there before in India.
Yeah.
So, but Chinmay, I would like to ask you here, like, how does these long short strategies actually generate returns?
So in any kind of a fund or of any kind of a product, there is a certain benchmark that you have to base your investment decisions on. And benchmarks are very important because that gives the fund manager a perspective from the investor's side. So what are the investors expecting out of the fund?
Mm-hmm.
And benchmark is something that you are expected to outperform meaningfully over a period of time.
Mm-hmm.
And that's where the endeavor will be.
Mm-hmm.
So any kind of a investment strategy, so whether it is fixed income, whether it is a long short fund, whether it is a large cap mutual fund or a small cap mutual fund, everywhere you have benchmarks set.
Mm-hmm.
And the idea is that the returns have to be somewhere in that kind of a ballpark.
Sure.
And that's the whole plan. And that's where what we are expected to do, and that's what we are going to aspire. In the case of an SIF, our endeavor would be to outperform the benchmark, obviously,
Mm-hmm.
but at lower risks.
Right.
So at lower volatility levels or at portfolio levels. So that is possible using a mix of long and short instruments, and that's where the thing becomes more exciting.
Right. It means you're looking at not only generating returns, but risk-adjusted returns.
Exactly.
Okay.
Superior risk-adjusted returns. So any long short fund, the function of that long short fund
Mm-hmm.
is to minimize the exposure to markets, minimize the exposure to risky assets per se,
Right.
and to generate a higher return or to generate a higher superior risk adjusted return kind of a thing.
So I would like to ask you here, Chinmay, like, how do you identify the short candidates? Like, which stocks are you not bullish at? So how do you identify?
See, that's a normal part and parcel in any fund manager's life. I mean, you are always positive certain stocks and sectors and themes, and you're always negative certain stocks and sectors and themes.
Mm-hmm.
The difference is, as a long only fund manager, you're not allowed to sell something that you don't have.
Oh yes.
तो आपके पास कोई स्टॉक नहीं है,
Mm-hmm.
तो आप वो बेच ही नहीं सकते अगर आप एक लॉन्ग ओनली फंड रन कर रहे हैं.
Right.
However, in the case of SIFs, हम अपने आप को उस तरीके से भी एक्सप्रेस कर सकते हैं. So we can short stocks, we can make money out of those stocks
Mm-hmm.
using certain strategies, and you can in the process provide a natural hedge to the portfolio as well on the long side. So जैसे आपका कोई, I mean, I'll give you an example of an 80-20 kind of a fund. When I say 80-20, it means कि 80% आपका long है,
Right.
20% आपका short है.
Okay.
Let's take this as a hypothetical scenario. तो
Sure.
इसमें आपका net exposure automatically 60 हो जाता है.
Okay.
80 minus 20,
Oh
60.
yeah.
तो आपका जो एक्सपोजर है इक्विटी मार्केट्स को
Mhm.
या एनी काइंड ऑफ अ रिस्की एसेट क्लास जैसे हम कहते हैं,
Right.
उसका एक्सपोजर ही 60% हो गया
Right.
कंपेयर टू 100% इफ यू आर
Mhm.
रनिंग अ लॉन्ग ओनली काइंड ऑफ अ फंड.
Right.
So on that, so automatically your risk is going down. So your
Mhm.
portfolio volatility will go down.
Mm-hmm.
And हमने ये देखा है over a period of time, over last several years, that the covariance
Mm-hmm.
in among stocks is generally in the region of 60%. तो
Right.
covariance factor यहाँ पे इसलिए मायने रखता है क्योंकि वो blended portfolio volatility calculation में काम आती है.
Right.
तो आपका blended portfolio volatility उस covariance की वजह से, जैसे एक स्टॉक दूसरे स्टॉक को कितना लिंक्ड है,
Right.
कोरिलेशन कितना है,
Mm-hmm.
तो उसका जो मैथमेटिक्स है वो अगर 60% इन दैट बॉलपार्क अगर है, एंड हमने वो देखा है कि विच इज फैक्चुअल,
Mm-hmm.
तो हमारा रिस्क ऑटोमेटिकली एट पोर्टफोलियो लेवल घट जाता है, बिकॉज शॉर्ट पोजीशंस act as not just alpha drivers
Mhm.
but also as a natural hedge to your long only positions. So it becomes a naturally safer product, so to say, if you are running those kind of, I mean there are cases when you may expect that certain portfolios may behave erratically. That's because the views of the fund managers and the views of those individual stocks have been wrong.
Right.
But the example that I gave was generically speaking, yeah,
Mhm.
naturally speaking.
Right. So when you identify a stock, like which is a short candidate for your portfolio, like do you look at the longer term, or these stocks are identified on the basis of short term?
So generally my thought process is that our portfolio construction, let me first explain how our portfolio construction is looking like. So 65 to 70% of our portfolio at any point in time will be invested in long-term compounding stories.
Right.
So typically any of the next 20 years or next 2 decades, उसमें कौन से sectors, कौन सी themes, जैसे EVs हो गया, renewables हो गया, fintech, edtech हो गया, AI, machine learning, उसमें कौन सी companies आएंगी, क्विक कॉमर्स हो गया, इसमें कौन सी कंपनीज वो है जो आगे जाके लिस्ट होंगी या ऑलरेडी लिस्टेड है, वो हमें अगले 20 साल चलेंगी। एंड वो 20 साल में हमें क्या वो 20% से ज्यादा कंपाउंडिंग इफेक्ट दे सकता है इन टर्म्स ऑफ आवर रिटर्न्स। अगर वो होगा तो दो स्टॉक्स विल बी अ पार्ट ऑफ आवर पोर्टफोलियो। दैट्स द थॉट प्रोसेस। सो 65 to 70% of our stocks generally, or of our portfolio, and I'm just putting a very random number, but in that ballpark, will be comprised of such longer term compounding stories. The balance 30 to 35% of the portfolio will be a function of certain short ideas, which will be more tactical in nature, and certain alpha maximization strategies, which will again be tactical in nature.
Right.
So आप जब short positions की बात कर रहे थे कि आप short candidates long term के लिए रखेंगे या short term, most of the times I would say they will be tactical shorts.
Okay.
Which would mean that they have to perform in a short period of time.
Okay.
They have to generate those kind of expected returns, and which when annualized will give you a superior return than are expected to rather give superior return than the index. And while at the same time protecting the downsides in case of some unknowns that were to happen.
Yeah.
So that's typically how our tactical short positions should help us in hedging, providing a natural hedge and allowing us to generate alpha. And so the focus will be on short-term returns for tactical shorts. The duration for the shorts has to be as minimal as possible so that the risks are lower.
Of course.
While annualized return are superior.
Okay.
So that's the whole entire portfolio strategy that will be following.
Right. And Chinmay, there is a common myth among the distributors and even the investors what we come across. Like they feel like derivatives are meant for leverage. So yes, we also tell them like derivatives can be used properly and efficiently. It's not just for the speculation purpose. So how would you like to tell audience like derivatives can be used tactically, not just to leverage? Are you going to use derivatives as a leverage product in the long short strategies, or are they going to be there is non leverage at all?
Yeah. So derivatives, so under the SIF guidelines, derivatives can be used, but leverage is not allowed. So that combines the best of both things. So automatically you are not allowed to lever. And automatically with using the short positions and with better advanced risk management strategies using derivatives, you can protect your portfolio using derivatives. You can generate alpha using derivatives, while at the same time not exposing your portfolio to leverage, which can effectively result in having leverage is where the problem really lies in derivatives. So derivatives per se are not the problem. Right. Leverage is the problem, whether it is knowingly or unknowingly. So whenever not a fund manager, but whenever an individual in the individual capacity exposes himself or herself to derivatives, knowingly or unknowingly, there is a leverage element involved. And that is where the real challenge lies, in not leveraging to the extent that you get busted on, that's the main issue with derivatives. And under the SIF guidelines, you're just not allowed to use derivatives. So that's the best part of SIFs.
Right. Yeah. Thank you for explaining this. I hope like this will clear that myth that is there in the financial world, And Chinmay, another thing here, if anything goes wrong with the short candidate that you have chosen to be the part of your portfolio, like are there any drawdowns level that you have, in mind that we are going to cut our positions? Are there any stop losses in place?
Definitely. So whether it is long or short, there will always be stop losses in place.
Okay. So you have those guardrails and
there are guardrails. So the guardrails are twofold. One is absolute stop loss and second one is a relative underperformance stop loss.
Okay.
So if I'm long a certain stock, if I've bought certain stock in my portfolio and it has gone up by 8%, whereas the index has gone up by 10% or 12%, then I'm underperforming the index to the extent of 2% or 4% respectively.
Okay.
So I will have an inbuilt guardrail, which even though I'm making money on that particular stock in that particular direction, it is underperforming, and we have those kind of guardrails in place wherein the positions will be identified and we'll be exiting those positions if at all they are not performing as per our core investment hypothesis. And so it's a the stop loss or the guardrails are going to be on both sides, not only on the short side. So on both sides you'll be having those guardrails. And the two most important things, जैसे दो बहुत ज़्यादा important चीज़ें जो हम करते हैं या करनी चाहिए, जनरली होना चाहिए, जो हम एक एज अ प्रोसेस करने वाले हैं, वो एक क्लियर इन्वेस्टमेंट हाइपोथेसिस, क्लियर इन्वेस्टमेंट हाइपोथेसिस टुवर्ड्स every single portfolio stock, every single transaction, every single tactical bet that we'll have. वो स्टॉक या वो ट्रांजैक्शन या वो उस बेट का क्या कारण है, उसका एक प्रॉपर डिटेल्ड डॉक्यूमेंटेशन होगा. वो डॉक्यूमेंटेशन होगा कि ये इसलिए ले रहे हैं क्योंकि या बेच रहे हैं बिकॉज ऑफ दीज रीजंस. एज लॉन्ग एज दैट हाइपोथेसिस इज होल्डिंग स्ट्रांग, that position and that portfolio stock will continue to remain. The moment the hypothesis is changing, so whether it is a function of your returns, हो सकता है कि स्टॉक चल गया है जोरों से, हमारा टारगेट तो मीट हो रहा है, so then the incremental return is not going to be that high on that stock because our return estimates are something,
right?
So then it may not feature on our radar as very attractive, and we may want to exit out of or trim down our positions in that particular stock because that has done what it was intended to do. On the other hand, there can be cases wherein it is not doing what we are intending to do. The stock is not doing something that it is intended to do. Our hypothesis is getting broken down. So something that we are expecting on earnings side is not getting met with. Something that we are expecting in terms of some sector specific development that is not happening, or adverse movement is happening, then we'll be exiting those kind of strategies because our hypothesis has not played out.
Right.
So having a very strong hypothesis is very important in any kind of a portfolio management strategy. So that's the first part. And the second part is attribution analysis.
Right.
At the end of the month or at the end of the week or whatever your frequency can be, you have to understand what is the contributor to outperformance or underperformance, or who has contributed, how much they have lagged, how much they have dragged. All those things are very important. So attribution analysis and investment hypothesis are the two most important things that we'll be having a part of in our investment strategy.
Right. Thank you so much, Chinmay, for clearing this out, And now I'm going to come to the question, which is, most frequently asked question by the investors and the distributors, like what potential that SIFs hold to generate alpha over the traditional mutual funds?
So generally what we've observed, and this is mathematical data that we've analyzed, is that returns come in bursts.
Right.
So you see stock markets doing really well or equities doing really well during certain time frames, and rest of the times they are generally trending downwards or flattish, and as a result of that you observe that the annualized CAGR returns over a longer period of time drops. So you may get a 30% rise or a 40% rise in a year, but if you continue with that same position or that same portfolio over a 3-year or a 5-year or 7-year period, eventually you will see that it will tend towards 13 to 15% kind of return. So that entire return that you get in bursts, SIFs or any kind of derivative strategy, I will not talk about SIFs per se, but any kind of derivative strategies have the potential to protect those returns.
Okay.
And hence improve the CAGR returns. There is again, I'll always use the word potential because it's left to the fund manager to actually execute what is allowed to him in the entire portfolio creation process and what these strategies allow him to do.
Yeah.
And the focus has to be on getting those strategies right. And if executed properly, then we've seen that those returns that you generate in bursts can be protected, and your CAGR returns have a potential to be higher than what the index can give. So longer term, if you think about a couple of cycles or 3 cycles, that is over a 5 to 7 year kind of a period, then logically speaking, if you have participated in the up cycle, avoided the down cycle to some extent, again participated in the up cycle, again avoided the down cycle to some extent, then your point to point NAV can be superior to a pure long only kind of a scheme. I mean, I'm again using this word because I have to be very careful using the words potential and scope for things happening.
Of course. Yeah, we understand, when you can protect your capital from going down, so it takes less force to go back to the level and generate returns for a particular fund.
Yes.
So having said that, I read about special situations too. So if you can throw some light on special situations, like what kind of special situations are you planning to venture into?
There would be some special situations which always are there on the anvil, and whether it is demerger, so certain company wherein we identify certain hidden asset value,
Right.
which can be demerged or which can be sold out, or where you can, which is not really built in terms of the overall stock's intrinsic value. So there are always some intrinsic values which are there in certain companies.
Right.
Demerger of those intrinsic values and the realization of the valuation of those particular hidden values can be a source of generating alpha. So so that can be one of the places to generate an orthogonalistic kind of return. When I say orthogonalistic, it means it's something that is not in line with the normal earnings momentum related trends.
Right.
So those kind of possibilities emerge, and we'll be making, so whether they are IPOs, listing gains, all kinds of instruments,
Buybacks and all that stuff too.
Buybacks. There are so many things which happen, which you can make use of, and you can benefit from them.
Of course. And it's really good to see, that regulator has given so much flexibility to the fund manager. And like special situation, other than this, we also saw about derivatives. If you can just throw some light on this too, like what kind of derivative strategies a fund manager can think of exploring into?
Yeah. So derivatives can be used twofold. One is for hedging, and second one is for a directional bet, which is on the negative short, short side. So a hedging position will be used when there is a known unknown, or there is something that you are fearful of that is likely to happen and which is known to you.
Okay.
So it could be prior to a certain event that is likely to happen, central bank events, or any kind of possible tariff kind of situations wherein there is a deadline looming, or any kind of an ultimatum related timeline. So whenever you are aware of some kind of times over after which something is likely to happen,
known events.
That is a known event. So you would want to hedge your portfolio to some extent.
Of course.
So you may prefer to hedge it using a short position by shorting the futures in the existing stocks that you have. You can use it hedge it using shorting of the index futures. You can hedge it by using put options, and you can hedge it by writing call options. So all of these strategies are valid. The attractiveness of a particular instrument at that point in time is a function of the volatility of that instrument. So whether you're running whether the options are trading at high volatility levels or low volatility levels, depending on that, the instrument of choice will differ.
Okay.
But all of these instruments are available, and all of these instruments we'll be using rather to avoid any kind of downfalls, and the optimized use of these instruments is important. So we have within our team certain analysts who are purely looking at derivatives. They have experience of running derivative prop books, who have done quantitative analysis in the past. So the team of analysts that is there in our SIF, in WSIF that is, they are specialists in derivatives and quantitative analysts, and as data scientists, so to say. So they are looking, so their job is to look at a lot of data. So other than the fundamental aspects that we have in terms of the team that we have on the research side, so there are specific skill sets that these guys bring to the table, which will be of extreme importance in the things in terms of the strategy per se.
Right. As we know, like there are different categories in the SIF, like we have equity, then we have debt, then we have hybrid. And if we talk about these particular two categories, equity and hybrid, where the funds have been launched, so how would I compare similar to the mutual fund category? Like if I have to talk about equity long short fund, so which mutual fund category I should be comparing it with?
So there are three funds on the equity side. So which is the equity long short fund. Then there is a X top 100 fund, and then there is a sector rotation fund. So these are the three funds that are there on the equity side. The equity long short fund is more on the lines of a flexi cap fund. So it is like a flexi cap mutual fund scheme because you can invest across market caps. The X top 100 fund is more of a mid and small cap category. So that category per se is not there in mutual funds at this point in time. But you can think of it as a combination of mid cap and small cap. So that's the second strategy.
Sorry. So I have a follow-up question here. Like mid and small cap, you mean like if they're going naked short, are they going to venture into mid cap only? Because there are very limited options in the derivative segment when we talk about mid and small cap.
So approximately 200 odd companies at this time, or 200 stocks at this time are in derivatives, are there in the F&O market. Out of which 100 will be the large cap and the balance 100 odd would be the mid cap names.
Okay.
Now, when I say mid and small cap or the X top 100, it means that more than 65% of my AUM has to be invested in mid and small.
Okay.
So the balance 35 can be in large
large cap too.
So when I talk about tactical derivative trading ideas or short ideas, the entire universe effectively is available even in the X top 100 on the derivative side to participate on the short side or any kind of advanced derivative strategies that you want to implement.
Okay. Thank you. And how about the hybrid, like hybrid SIFs? I can compare them to which category of mutual funds?
It's mostly on the asset allocation or the BAF side. So wherein you have a mix of equity and fixed income, and depending on optimum asset allocation mix, your mix change can affect your return expectations and your outperformance to the overall. Generally, we use CRISIL balanced fund, balanced index, etc. So your idea is to outperform that index using an optimum asset allocation mix. So once you have fixated the asset allocation mix, then it becomes a question of whether you are choosing the right stocks or not within those, or choosing the right instruments or not within those, which is supplementary.
Right. And Chinmay, like market has not delivered any return in the past 2 years or 1.5 years to be precise. Like, how do you plan to generate returns in the sideways market or the bearish markets?
So during bearish markets, so generally, if the market is moving one-sided on the upside, that is particularly, you see every stock going up broadly.
Yeah.
And when the market is sideways, that's where the key differentiation happens really between which are the good quality companies which are going up and which are the so-called not so good quality companies which are going down. So as a long short fund manager or anyone who is running a long short fund, I think these kind of markets actually can help you identify those kind of, or not just identify, but benefit from those kind of strategies more. That's my personal opinion, that whenever the market is choppy or flattish or trending downwards or, not really in a highly liquid kind of a phase, I think the probability of generating alpha using a long short fund is higher, in my opinion, than a long only fund.
Okay. So what I understand from this is like the volatility is the best friend for the SIFs.
It could be used. Yes, it could be used well. If used well, it could be a friend to you. Yeah.
Okay. So Chinmay, how transparent are these products going to be? Like in mutual funds, like we do have fact sheets, declared at the end of the month. And especially like we are going to have derivative strategies here. So how transparent are SIFs if we have to talk about, the portfolio structure?
So it's the whatever kind of disclosures are available in mutual fund, which is maybe daily NAV or end of month portfolio disclosure, etc. All of those disclosures are evident. Are going to be there even in SIFs. We have to disclose your daily NAVs. We have to disclose monthly portfolios.
Okay.
And so whatever is required, whatever a mutual fund has to disclose, we'll be also disclosing on similar. So at disclosure levels, broadly, I would say it is at par with mutual funds.
And Chinmay, how these risk bands are defined in hybrid specifically? Because I have seen like there are many AMCs who have already launched their funds. Few of them, like they are in the similar category, but they have different risk bands. So if you can throw some light, like how these risk bands are defined by the regulator.
So there is a proper circular which is there from the AMFI side, and we have looked into that, and it's a function of several factors.
Okay.
So it's a function of your portfolio creation. How much is the equity portion? How much is the fixed income portion?
Right.
Within the equity portion, what is the weightage of a certain stock and what is the volatility of the certain stock?
Okay.
And the sum product of that, gives to you the portfolio level volatility. That itself is one of the drivers for the overall risk band. Okay. The second thing is what is the rating within your bonds? What is the rating of those bonds? What are their weights? And what are the durations of these bonds? Okay. So within on the fixed income side, it's a function of what is the duration, how risky the bond is, and based the higher the bond duration, the higher the risk, the lower the rating, higher the risk. Similarly, higher the volatility, higher the risk. Lower the volatility, lower the risk, and it's a summation of all of these factors. Whether it's a sum product of all of these factors which results in the overall risk band per se.
Oh, so that's why we have seen the huge variance within this category. Like some funds are still in positive in the falling markets. So I'm talking about the hybrid funds, and some were falling. So that was the question that come across.
So higher the equity linkage, higher the closeness to the equity market indices. If they are going to fall, there is a higher closeness to that. The more you stay away from the equity market as a product within your portfolio, I think the higher the deviation will be from the index and benchmark, and lower will be the correlation with the index per se.
Yeah, so in this scenario, I would suggest investors to look at the portfolio structure, how these are going to be, because not just looking at the category of the fund, you can decide, okay, this SIF is from hybrid, so this looks safe to me, because within that category, there can be so much variance in the returns.
Yes.
Thank you. So, Chinmay, I would like to ask you here, like SIF performance in the falling market and in the rising market, like what kind of beta or they can deliver, like what kind of risk adjusted return you are looking at, especially in the falling markets?
It's very difficult to answer a question in a quantitative way.
I understand.
Let me give you the philosophy behind it. That in the case of a falling market, given that your net exposure, if you're running a long short fund, to the extent that you're running short, and to the extent of the beta of those individual short positions and the beta of the individual long positions and their weighted average beta on the long side and the short side, and and their own internal volatility levels and their internal covariances, I think there is a lot of calculation that has to go into to understand what can be the return that can be delivered in us if the market falls by 5-7%.
Right.
That's the first point. So it's very difficult, but generally speaking, given the lower exposure to the equity or the index as a whole, we expect that during a downturn, there has to be a slightly lower fall that we can see, or much lower fall, depending on how the portfolio is organized in the case of a long short fund. And during a raging bull market, so whenever you're expecting the market to deliver in a particular year, let's say 60% or 50%, typically that happens from a sharp drawdown that you would have experienced in the years prior. So typically when you've seen the COVID fall, markets fell down by 40% and then rose up by 120% the next year. I think those kind of extraordinary situations are where when the market is falling, you will outperform meaningfully. When the markets rise crazily, you may underperform during that period. But what you have to think about is the probability of those events happening going forward.
Right.
How probable is a sharp rise in the market? How probable is a sharp fall in the markets? And it's a function of whether those kinds of events are most likely events or difficult to happen kind of events.
Right.
And and the portfolio returns will be a function of that, frankly. So, it should broadly be a function of how the fund manager is looking at a certain situation, what kind of volatility and what kind of beta is introduced, what kind of short positions he is having, and their internal covariances. And it will be difficult to judge give you an exact answer.
Yeah, I understand. So basically, it's kind of risk adjusted return that fund manager is trying to achieve. And what investors should look at. It's not just that they are trying to participate in the bull run and the markets are falling down. They are protecting capital, but the kind of risk they are taking to generate those returns should be the key.
Yeah. I think the clear assessment of the risk. So, what is the attribution of the outperformance in terms of the risk level that you've ascribed to that? So you may outperform taking higher risk. Now, are you getting compensated for the higher risk is what the question should be asked.
Exactly.
So you have taken a higher risk, you have delivered a higher return, but are those returns commensurate with the risk that you've taken? I think that's the thing. That's going to be the clincher. And from our perspective, we are looking to minimize volatility to the extent possible, while the focus is always going to be on alpha maximization. So, that's the way to think about.
Thank you, Chinmay. So now, Chinmay, if you can also let us know, like, what are the plans of the wealth company to bring its SIF? When are you launching, and which fund are you focusing on?
Yeah. So we are coming up with our NFOs in April. So 15th of April is the start date. 29th of April is the NFO closure date.
Okay.
So we are coming up with two strategies: the equity long short fund, which will be like a FlexiCap plus, wherein you have a FlexiCap strategy under that particular fund.
Okay.
And the second one is the X-Top 100 fund, which will be on the mid and small cap kind of a category, wherein more than 65% will be invested in mid and small cap names. And these are the two strategies on the equity side that we are coming up with. And as and when we keep getting approvals on the hybrid side, we'll be launching those products as well going forward. But at the moment, these are the two funds that we'll be launching, and using all the kinds of investment strategy and principles that we talked about earlier. I think all of them will be put to test. The focus will be a lot on data, a lot on quantification of risk, a lot on risk adjusted returns, and alpha maximization strategies. So all of these things will be the key drivers of our fund performance going forward.
So based on your experience, we are looking forward to it. And also, Chinmay, on our audience demand, they usually ask us to have a rapid fire questions with you. So if we can have this round quickly, maybe, one word or one liner answer would do. So one biggest mistake retail investors make in the volatile markets.
So whether it is volatile markets or, markets which are doing exceedingly well, or any kind of a market, the biggest mistake is asking, market mein paisa lagao kya?
Yeah.
So market mein paisa lagao kya is not the right question. The question is, here is my expectation from my portfolio. I am expecting certain cash flows going forward. I have to invest. So is this the right portfolio mix for me at this point in time? So for which a lot more data has to be provided, such as what is your current investment asset allocation primarily? Is your asset allocation appropriate or not? If it is already appropriate, why change it? If it is not appropriate, then maybe you want to change it at any point in time. So that is one of the questions that I find it difficult to answer to anyone. Ki aaj market mein paisa lagana chahiye kya? I mean, I don't know. I mean, you have to tell me a lot more.
Yeah.
You have to give me your expectations about your own cash flow requirements going forward. How are you
time
currently
horizon,
invested?
risk appetite.
I mean, there are a lot of things that go with it.
Yeah, of course. Okay, so Chinmay, long only or long short? Which wins in the long run?
So if executed well, so a long shot is something that has a benefit over a long only because it can do something more. So over a longer period of time, if executed well, a long short strategy can work better than a long only strategy, in my opinion.
Okay. So what is your key strength that investors can count on?
So as I mentioned earlier, I think the two key strengths or the two key processes that we'll be following are investment hypothesis and attribution analysis of the portfolio. I think these two things are the most important things that we'll be focusing on in the entire portfolio creation and construction journey as such. And I think these are something that I am personally pretty much sold on to, and we'll be executing it to the T, and hopefully they will deliver going forward.
Okay, FOMO or fear in market, which is the biggest enemy today?
Today seems like the fear in the market. I think it's more about the market going down rather than fear of missing out at this point in time, because people are really worried about the market, and I think reading a lot on the newspapers and moving along with it, and which I find it quite strange personally. But yeah, I mean, that's something that we are observing at this point in time.
Thank you, Chinmay, for sharing these beautiful insights. One last key takeaway for the investors and the distributors who are, still thinking of investing into SIFs.
Yeah, I mean, I think the most important point is understanding the philosophy of the fund, understanding the fund in itself, understanding it from your advisors or yourself. I mean, I think understanding of the product is very critical, because I think that's the best myth buster for yourself. I mean, you can bust the myth yourself rather than looking into someone else to drive you. So I think understanding the product, understanding the nuances of the product are very important, and that will go a long way towards understanding what is the best product that suits you.
Right. Thank you so much, Chinmay, for sharing these valuable insights with us. And we look forward to the wealth company's SIF that is coming up. And, your experience looks promising here, and investors are looking forward to it.
Sure. Thank you so much.
Brilliant insights, Chinmay. I think आज के एपिसोड में हमने SIFs को सिर्फ सरफेस लेवल पे नहीं, बल्कि एक्चुअल स्ट्रेटजी लेवल पे समझा. फ्रॉम हाउ अल्फा इज जनरेटेड to how risk is managed, and most importantly, how these products behave in a real market condition. For anyone watching this, अगर आप अपनी इन्वेस्टमेंट जर्नी को नेक्स्ट लेवल पे ले जाना चाहते हैं, तो सिर्फ रिटर्न्स नहीं, स्ट्रेटेजी समझना जरूरी है. And that's exactly what we aim to bring through conversation like this at SIF 360. So if you found this valuable, like this video, share it with someone who is serious about investing, and subscribe to stay ahead of the curve. Also, if you want to explore SIFs or understand whether they fit into your portfolio, feel free to reach out to us at sif360.com. Until next time, invest smart, stay informed. Thank you.